Welcome to Start 100K, where I'm helping people get to their first $100,000 of net worth. Today I'm going to talk about probably the biggest wealth suck of anybody that is trying to get to the first $100,000, and that's vehicles. It's kind of a touchy subject for some people, and I'll be honest, I've had a lot of anxiety around making this particular video. I actually recorded a video about this probably about a month or two ago, and it just, for whatever reason, I just got caught up on it, and I just kind of just trashed it. So it's come up again because it comes up all the time. So here I am. I'm going to give it another shot. So without further delay, this content is not intended to be tax, legal, or investment advice, so please run your individual situation by a professional. And please share, comment, subscribe. Definitely share. And please join the community, the Facebook group, and get the word out there. I'm just trying to get this information out to people and hopefully open up some thought that might help somebody out there. So let's get started. So I did a little research, and the average cost of a new car in the United States, average car loan rather, is $34,635. That's not a small number, and then that's at an average rate or a term of 70 months. And then the rates vary quite a bit. So with good credit, it said you're at 5.49%, which I still think is kind of high. With, the average is right at 9.46%, which seems even higher yet. And then with, less than good credit, it says it's at 22.66%. I honestly had to kind of stop for a second, because if that's the average, that means somebody's, average for poor credit, that means somebody's paying a lot more than that. And that's, 22, that's almost 25% interest. Like that's rough. Like it's going to really, that's going to really hit you hard. The bank's going to make a lot of money off of you. So what I did is I looked online and found the vehicle that I could buy with $34,000, dollars, that was as close to that mark as possible. So that was actually a small pickup truck, a Chevy Colorado, with a purchase price of $34,000, and this is MSRP, by the way, $34,480. So if I purchased that truck and I financed it even at that low margin, at the 5.49%, and then the typical term is probably 72 months. So for 72 months, my payment is going to end up being right at $563.17. So in 5 years, so here's where this gets a little bit weird, or like this is where like it gets really important to look at. So in 5 years, the total interest paid is going to be $6,000, and $6,068.17 is what it comes out to. So you could buy a decent used car for $6,000. Now, if we go up to that 9%, now we're getting a a little out there. So that's going to end up costing you $10,000 in interest. Well, actually, almost $11,000. I mean the truck I've had for the last 7 years, I bought in cash for less than that. So just take that for what it's worth. Now, whenever we get up to that 22% mark, now that's where things really get hairy. So that ends up being $28,000, $873.38 in interest. 22.66%. You're almost paying for that vehicle twice. And this doesn't even take into account that this is just the interest that we're talking about. I'm not even talking about depreciation. So depreciation. So as soon as you buy that vehicle, so you buy that brand new vehicle. So for $34,635. After 5 years, it's going to be worth quite a bit less, and it's going to end up only being worth about $27,000. Now this is estimated, of course, but $27,462. So, and this doesn't even. This is if you bought it in cash. You're gonna lose out. You're gonna lose out almost, what is that? Almost $7,000 just in depreciation. Then you add on the $6,000 on top of that. So you could have already you're really just, like I said, that's really a big suck to your overall net worth. And with that, it's going to take you roughly 2 years. So just figure, if you buy a new vehicle, it's going to take you about 2 years just to break even. So what that means is you're going to pay on it for 2 years. So you're going to pay that $563 for 2 years. So this is the best case scenario. So if you pay that that $563, what was that? $563.17, 24 months. So you're gonna pay $13,516, and you'll have basically nothing to show for it, because if you sold that vehicle, then you would just be zeroed out. You wouldn't gain anything. You would net $0 off of that sale. And there's really a much better alternative. So there's 3 different factors that we're talking about here. So one is just the fact that a vehicle is not an investment. All right, I don't. Yeah, it's just not. It's a tool. All right, it's a tool. It's a thing. It's not an investment. It's not going to make you money. Now, yes, you can use that to make money if it's for a business, so on and so forth. But that's a whole separate deal. Now, you've got depreciation working against you. I cannot spell tonight. You have interest. And then you also have maintenance costs. We didn't even talk about maintenance costs. So all of those take away from that value of that vehicle or cost you money. And this is really important, because if you're trying to get that to that $100,000 mark, that high rate that you're losing out on, or that you're losing in net worth every year, is going to keep you from ever getting ahead. So say, for instance, if you had, let's say you're already at that $100,000 mark. So for me right now, I'm sitting at about 60% of investable assets not right. Well, yeah, pretty close to that. But when I hit the $100,000 mark, or when we hit the $100,000 mark of net worth, we had about $60,000 to invest. So, and you can figure safe rate of return is no more than, and I'm saying no more than, and this is safe rate of return, around 8%. So you can argue that one way or another, but that's general conventional wisdom, and most people in the financial services, say that's about what you can expect to get a return overall. Now, or we'll say 6 to 8%. So we'll say, 6 to 8%. But we'll be optimistic, and we'll say 8%. So even if it was 8%, $60,000 at 8%, you're going to gain $4,800 a year. So that's how much your assets will grow per year. Now, if you buy a $34,000 vehicle, like that Chevy Colorado, so you're gonna that first year, and this is just the first year. I'm not talking about 2 years or whatnot. That first year, you're gonna lose roughly $1,800 in interest, and you're going to lose roughly $1,200. This is according to Edmunds, in depreciation. So, so that works out to where you will net. You only have a gain. So instead of gaining $4,800, you're actually only going to gain $1,400. Now, let's say if you're a 2-vehicle household and you financed both vehicles, then now what's going to happen is, instead of gaining $1,400, you're actually going to lose some of that money. So you're actually gonna end up in the hole. So actually, I looked at my notes wrong whenever I did this. So this, so you would actually be ahead 1693. I apologize. So that's what you would be up. And if you financed both vehicles, you'd be losing 14 every year. So it's really hard to get ahead whenever you're losing money. So if you can at least take one of these things off the table. So interest, that's the easiest thing to get rid of. You can't get around depreciation. You can optimize it. So you can look at websites like Edmunds or even Kelley Blue Book. They'll give you an idea of kind of depreciation for the types of vehicles that you're talking about or that you're looking at. But all vehicles depreciated. The second you buy it, it's worth less than what you paid for it. So that's just it's just one of those things I got wrong for the longest time, but it is something that kind of woke me up and actually made me think about how much money I was just giving away to the bank so that I could have something a little bit sooner. Now, the alternative, if you can pay your vehicle off or get a cheaper vehicle, then you can take what you are paying. This is what that's what we've done. We've bought 1, 2, 3, 4, 5, 6 vehicles in cash since we started doing this, ranging in value from $2,400 to right around just a little over $20,000 in cash, just by doing this simple thing. What we were paying in car payments, which is roughly around $600 a month. Now we put that in a savings account, or what I call a vehicle fund. And then anything we need for vehicles, it comes out of that account. And then when we need to replace a vehicle, then we look at whatever's in the vehicle fund and we buy a vehicle. So it's worked out really well. As far as I'm concerned, we'll continue doing that forever. So that's a different way to do it, to where you're earning a little bit of interest on your savings account, probably not much, but at least you're not really losing money, at least to interest. So, yeah, well, I hope this is giving you kind of something to think about if you're looking at buying a new car or anything like that. I know that it's really tough to kind of hold back on buying a new vehicle sometimes. I know I get real itchy to get a different vehicle, especially I drive a rusty old pickup truck now. It's due to get replaced here soon, but I just don't have the cash to replace it right now. So I'm still saving up for what I really want. But anyway, hope this has been helpful. Don't forget to share, comment, and subscribe. And yeah, have a great day. Thanks.